Does technical analysis work? No. But also yes, but mostly no. Plus, I'll show you some things that I believe do work, and maybe we'll have a couple of goodies at the end, so check it out. Hi, I'm Speculator Seth. You can join me every morning from 8:20 to 10:30 Eastern Time when I stream here on YouTube, so make sure you hit that subscribe button and hit the bell icon so that you know when we're live. You can ask me questions. It's always a great time, so I hope to see you then. Technical analysis is probably the most controversial subject in trading because there are many people that base their trading on technical analysis, but there is a lot of people that also say that technical analysis simply doesn't work. So what is it? What is my take on it? And as I said in the intro, I think that my answer is no. Mainly, it does not work, and there are two big reasons why I say it doesn't work. So the first thing that I want to say about technical analysis is that the underlying theory that it's based on just isn't true. And what I'm talking about is the efficient market hypothesis, or the idea that asset prices fully reflect all available information. That basically you can look at a stock chart and you can know everything that there is to know about an asset's current value because all of the traders have baked that information into the price movement. And it's just not true. Markets are not really that efficient in the larger scheme of things. They are more efficient and, more importantly, more fair than any other way of determining asset prices that we know of. But in real terms, that's really not all that fast. Sometimes it takes markets a really long time to figure it out. I remember when quantitative easing was first started, and in that day, the S&P 500 closed down, and it was a big deal. All of the news headlines said that the markets closed down because they started quantitative easing. And of course, as we all know today, that was probably one of the best times that you could have ever bought stocks. They're wrong. Listen, guys, the market is wrong all the time. That's how we make money. If the market was never wrong, we would never be able to make money. The truth is, it takes markets quite a bit of time to price in new information, and not everybody has access to the same information. Sometimes people are just wrong, and sometimes market movements are just random. So how can we really say that the asset price fully reflects all of the available information out there? There could be somebody ready to buy an asset, and this asset is not going to reflect that in the price because they haven't bought it yet. That's information that you as a trader can take advantage of. That's how we're able to make money. And that brings us to the next point, which is that a lot of market action is just random and is likely to break any pattern that you're possibly going to see on a chart. There are players out there that can include big traders, large institutions, and even foreign countries that have a huge impact on prices, and they can really move an asset any direction that they want on a whim. The markets are very prone to try and hunt stops, which means that they will move in one direction until everybody that they can stop out has been pushed out, and then they will immediately flip on you and go the other way. And so they don't care if there's a head and shoulders or support and resistance or some moving average there or whatever the deal is. The traders can move it to where they want it to go. And that makes technical analysis an extremely unreliable indicator for your entries and exits. I can't tell you how many times I've gone through doing back testing of statistics, some market concept that somebody has told me about, and when I go in and I back test it, it turns out that there's no edge in it. It's either actually has a negative edge and you're going to lose money from trading it, or the amount that you make is barely enough to cover the commissions. And the only things that I ever found that ever had any really good probability were things that were based on volume. Anything that was just based on the movement of the stock, like the shape of a candle or a head and shoulders pattern, has never worked out. Now, that doesn't mean that technical analysis is useless. And that's why I say that the answer is no, but also yes. because technical analysis is still something that I think is important to know and that I think you should study, because it tells you so much about where markets are and what other people are going to be looking at. You're going to see key levels that other traders are seeing. You're going to get an idea of, is the overall market sentiment bullish or bearish at this moment? And these are all key clues for context that you're going to need to be able to use for your trades. So with all that said, what does work? Well, what I recommend is anything that has to do with people actually placing orders. So an indicator that shows you volume or that shows you activity in the level 2 are things that you can use as a short-term trader for your entries and exits. And there are a lot of indicators that include this kind of information that you can use as trading, and every successful trader that I've ever met has used one of these tools as a guide in their trading in some form or another. So one of my favorite is VWAP, and I have another video about that on this channel, but that is a really great job to show you where people have taken their positions, and you can use as a guide as to whether we are bullish or bearish, and I think it's a really useful indicator. Cumulative delta is another indicator that I use on almost every chart, and this is basically all of the market buys minus all of the market sells, and it basically gives you an idea of which direction the market orders are going. And you can't necessarily use this as a signal per se, but it does alert you to opportunities in the market, and it can be really useful in helping you determine which way things are going. So the next kind of indicator that I would recommend is any indicator that gives you a good idea of what the trend is, because the biggest mistake that we make as short-term traders is trading against the trend. And if you have an indicator on there that gives you a straight it's trending up or trending down sort of a signal, you can use that as a guide. I wouldn't necessarily use it as your entry signals, but it's definitely something that's useful on there if you have a problem trading against the trend. One of the indicators I found most useful for that is the CCI. You could also just use a moving average though. And again, I wouldn't use it as a signal, but kind of more of a guide, whereas like if we're trending up, I only want to take longs, that sort of a thing, right? The last type of indicator that I would recommend is anything that gives you an idea of how far the market is moving at this current time. And so the two things that I look at for this are average true range and swing indicators. So average true range, I can go and I can look at what was the range of a 30-minute bar on average, and I can use that to get an idea of how far does this instrument tend to move in a given 30-minute period, and then I can use that to adjust my targets and entries and so forth based off of how far this particular market is moving. And you do the same thing with the swing. I can see, oh, the past swing we've been moving 8 ticks up and 5 ticks down, and that doesn't mean that the next swing is going to be 5 ticks up and 8 ticks down or whatever the deal is, but the tendency is that if the last swing was rotations of 5 ticks, then the next swing is going to be rotations around 5 ticks. And so you shouldn't be taking a trade at that point expecting 16 ticks, right? So this is a really good guide. So that's all I have to say about that. Hope to see you guys when I stream in the morning between 8:20 and 10:30 Eastern Time. And in the meantime, stay profitable, friends.